morning, good afternoon, or good evening, everyone, and welcome to this SuperReturn Webinar on ESG and sustainable investing in emerging markets, benefits, challenges, and practical tips. My name is Priscilla Boiardi, and I work in the Private Finance for Sustainable Development team at the OECD, and I have the great pleasure to be the moderator of today's session. So before we start with our fantastic panel, I just wanted to give you some insights to help situate ESG and sustainable investing, and also maybe to help clarify why it's so timely that we discuss this topic today. So I don't know how many of you know this, but the ESG term was first coined in 2005 in a landmark study, which was entitled Who Care Wins. And since then, things have grown exponentially. And today, ESG is really a rapidly growing market, which was estimated at the end of 2019 to have exceed $30 trillion in total assets in the 5 top major markets. And this was a 30% increase compared to 2016. So as you can see, a really fast growing market. There are different drivers and different incentives behind the adoption of ESGs by different actors. For example, investors are increasingly using non-financial information, and in particular the environmental non-financial information, to improve their decision-making and to improve the long-term risk-adjusted returns on their investment. This was recently highlighted by Larry Fink, who is the CEO of BlackRock, who joined the OECD Blended Finance and Impact Week, and clearly stated that climate risk is investment risk. And I think we can all see that today in the midst of the COVID pandemic, which is probably just the tip of the iceberg. At the same time, policymakers are increasingly signaling to the financial sector that it has to become a force for good and a force for sustainability. And therefore, there are social expectations of better business conduct and clear positive role for business in society, with the inclusion of ESG criteria, which can really help. Banks are also increasingly using ESG for the due diligence in their lending practices. And this really helps strengthen the integrity of the sustainability of their financial instruments. However, there are a number of challenges. A recent OECD study, the 2020 OECD Business and Finance Outlook on Sustainable and Resilient Finance, has highlighted that current market practices, from ratings to disclosure and individual metrics, present a fragmented and inconsistent view of ESG risk and performance. So just to give you an idea, the Outlook mapped the average correlation between different ESG ratings for the same company. So a single company that is rated across different ESG criteria, their correlation is around 0.4. And this is very low if it is compared to the average correlation of credit ratings, which is more like 0.99. So this wide variation means that the link between the financial materiality and ESG factor is unclear, which in very simple words simply means that it's unclear whether ESG performance really means higher financial return. On the development side, similar issues have been identified. We published what you found highlighting that even if development finance institutions have ESG policies, they don't always disclose the results of their ESG assessments. And this reduces transparency, which is another great issue on ESG. But these challenges really do not negate the benefits, and the information collected through ESG screening really offers valuable insights into how companies are managed, into how they are operated, and this can really help support long-term investing. So the question we are asking ourselves today are many. Some of them are, for example, is it possible to maximize social impact, societal impact, and financial returns? Does this come with higher risk? Is there a performance trade-off of ESG responsible investing? What are the benefits of implementing sustainable business practices across emerging markets and of incorporating ESG risk management into businesses? We have the chance of discussing this issue with 3 fantastic speakers. We have Menno, who is the partner and managing director of fund investments at Sarona Asset Management. We have Rashad Kaldany, who is chief investment officer at BlueOrange Sustainable Capital, and Nicole Mertens, who is head for Africa and Middle East of the United Nations Principles of Responsible Investing. So we have a number of questions that we want to ask them, and I will turn to them in a second. But before I do so, I just want to remind you that we also want this to be interactive. We want you to take an active part. So please don't hesitate to ask your questions. You can use the Q&A box to put all your questions in writing, and we will have about 15 minutes at the end to try and ask our panelists all of your questions. So maybe I will start maybe we can start looking at ESG investing and the developments. And I would like to start with Menno and Rashad and ask you if you can tell us a bit about what you've seen as development and evolution in the past 15 years, especially in emerging markets when it comes to ESG investing. And maybe also if you see any difference between emerging markets and developed markets. So please, Menno, the floor is yours.
Thanks a lot for the great introduction, Priscilla. Indeed, I've been investing in emerging markets since 2005, always with an ESG angle. At that time, I was at FMO, a Dutch development finance institution, and I've always kept the ESG angle, so I've seen the development over time. I started my career in India, and at that time, when you wanted to invest in companies, you were saying to them, we also have the requirements around your ESG. They really got puzzled. They had not heard of it. They didn't understand it, and they were afraid of it, and typically didn't see the benefit. I really think it's because of lack of knowledge around that. So a lot of time was spent on explaining the needs, and I think also quite often they agreed to our ESG requirements because they didn't have other sources for funding, to be honest. But that really has developed over time. I think companies you speak with, they know about ESG. Staff at companies find it important. Their clients find it important. So I think there is now the ecosystem has really strongly developed. And I do believe that the development finance institutions around the world played a key role there. They have been for a long time the largest group of investors in emerging markets. They've always taken high ESG standards as an approach, and I think they've also shown to entrepreneurs how it is benefiting them, and also showing it's not that costly or that complex as they may think to implement ESG standards. And that's I think something that still needs attention today, where you run into entrepreneurs who find it important to implement ESG and they want to implement it, but there can still be challenges to, okay, how do we implement it? And they need support with that, and they need to have dedicated support, and also how do you say that, a consistent support from their investors. That the more investors ask for the same ESG matters, the better it works out for the entrepreneurs in the end.
Thank you, Menno. Rashad, do you want to come in and share your experience?
Yes, very much so. I agree with Menno's description. I'd like to add a few elements. If you say since 2005, what has happened, I'd like to highlight a few things. One, started out ESG, and it's really more ES, and the environmental and social aspects of a company's operations, was an approach of do no harm, largely led by the World Bank Group with what used to be called the safeguards, literally, now called more performance standards, which have been adopted by many of the banks and financiers, and it remains a benchmark that people aspire to meet. However, I'd say over the last 5-10 years, there's been increasing emphasis on demonstrating positive impact. Not just you're not doing harm, but the investors want to know what good are you creating. So that's, I think, one important development. The second, I think, is the SDG framework, which was established 5-7 years ago, which provided a framework for people to try to coalesce around. However, that framework is a bit challenging. It was established for governments more than for private sector, so there's an ongoing process to adapt it in some way and make it more user-friendly for the private sector. But we at BlueOrange have adopted that framework to try to provide us a framework that we can more easily communicate what we're doing. The last thing I'd like to point out, while yes, there's been increasing attraction to this approach of sustainability or impact investing, the reality is it's as you mentioned, it's a very fragmented approach. There are many different methodologies that have been adopted, and while I have some sympathy for continuing to be open to new approaches, I think it's in the industry's interest to try to converge towards 2 or 3 approaches. It will facilitate the job of investors to assess managers on what they do. It'll facilitate what the manager's job to do their own job. So yeah, still quite a few challenges. And last but not least, I think the point you brought out, Priscilla, in your opening remarks about the link is not so clear. I think that's always been an issue, and it remains. So we haven't proven the case. You mentioned it's not clear that investments that have a high standard on ESG have higher returns. Is that the objective that we should aspire to? There are many questions which we can discuss later in this seminar if you'd like.
Perfect. Yes, you've already raised some of the issues, so thank you very much. I think this was very useful. Nicole, you work for the Principles of Responsible Investing. They have been launched in 2006, if I'm not mistaken. So I would like also to ask you, what have you seen? How have you seen the market evolve? I mean, I think UNPRI now has about 3,100 signatories, if I'm not mistaken. So very large number. So what do you see? How do you see ESG evolving from your vantage point?
Sure, thanks. And thanks again for the invitation to be part of this discussion. And I think a lot of the points that have already been raised, I can definitely corroborate. And I think from our side, some of the things that I think definitely stand out is what Rashad was referring to as the sort of evolution of thinking around ESG from a risk mitigation lens now towards an opportunity identification mechanism. And, drawing on from your introductory sort of remarks that, we really see that this take up of responsible investment, and like you say, we've got almost 3,500 signatories globally now, and they represent more than $105 trillion in assets under management. So it's more than half of global institutional investment that's now represented by, so-called responsible investors. So it's definitely a mainstream approach, and that's really been driven by 3 things. The first one is this understanding, though, like you say, the link is not entirely clear, but there's an understanding that what we've traditionally considered to be non-financial factors, these ESG factors, do have financial implications. And we do see it in the positive and in the negative, right? So when they're not taken into account effectively, they are paid for later. And when they're not, and when they are taken into effect, I mean, there is research that says that, companies that effectively integrate material ESG issues have lower costs of capital and better loan spreads, better customer loyalty. And those are the kinds of things that as an investor you want in the companies in which you're investing. So the links might be more intuitive than quantitative, but they're definitely there, and we can't deny that the ESG factors are material financially. The second thing that's driving it is really market demand. So there's increasing pressure from an increasingly educated and conscious market, especially for institutional investors in the form of beneficiaries of, for example, pension schemes that are asking now, not just will I retire well, but what kind of world am I retiring into? And what are you doing with my money to create that world? And the pandemic has brought that into sharp focus, where people are saying, it's all good and well that I own 0.0001% of Google, but I'd much rather you have used that money to build a hospital in the community where I live. So there's a lot of pressure on investors now to start thinking more systemically about the way that they invest. And then the third one, I think, is that, like you rightly pointed out, this policy and regulatory pressure. There's a vast number of markets that have signed up nationally to targets like the Sustainable Development Goals or the Paris Agreement on Climate. And the only way we're going to meet those targets to which we've committed is through intervention in capital market functioning. And so we're seeing that policy and regulation pick up in a big way. So I think that's what's driving it sort of generally. And the evolution in thinking that's happened is really about understanding that nobody invests in a vacuum. We're seeing investors increasingly understand that ESG is more about, it's about more than just which factors impact one asset or even one portfolio. It's about what is the impact of my investment decisions on broader market stability, so environmental, socioeconomic stability, because that in turn affects the ability of my portfolio to generate return. So just as we always hear, this adage about how there's no returns on a dead planet, similarly, there's no returns on a planet where everything's descended into chaos because we mismanaged inequalities or community issues or health. And so investors are increasingly starting to understand that and thinking about their investments much more holistically. On an emerging market standpoint, I think what's really interesting, and this is really, I think Menno already mentioned it, is that the conversation has for a longer period been stuck in the why and the what. So what is this? Why is it relevant? But recently, I think what's been really exciting is this shift to the how. So, even just 3 or 4 years ago, you could be in a room with investors and have to still explain what is ESG and what are we talking about when we talk about responsible investment. And there are still instances where that's the case because there's always going to be people who are just starting in this journey. But overwhelmingly now, the conversation isn't about what is it and why does it matter. It's about how do I do this? How do I start? What's my first step? And that evolution, especially in emerging markets, is really exciting to see.
Fantastic. Thank you so much, Nicole. And well, since you brought this up, we can maybe move to talk a little bit about the how. So how do you integrate ESG into your practices? And I would like to start with Menno. Menno, you are responsible for selecting, reviewing, and negotiating investments in private equity funds. So how do you integrate in practice ESG criteria in your due diligence processes, and how do you follow up and support the investors? And perhaps you can also tell us a little bit about the main challenges that you face in the process.
Yeah, absolutely to do so. Look, most of what we do is we invest through funds and co-investments as well. And what we do when we invest in funds is we ask for the fund managers to have an ESG policy in place. And the ESG policy is developed towards the exclusion list that Rashad talked about. What don't we do? But then it's also around, okay, what is the status of a company when we invest in the company? What are the ESG risks to be solved? And what are the possible impact opportunities to be achieved? And that the private equity manager has a policy around implementing such a plan and implement that at the company. And some of these some of those things in the plan can be implemented immediately, and some of them you need to be realistic, and that takes some time. And I think the great thing about this, what Nicole mentioned about that we don't ask much about the why and what anymore, is that we are such an ecosystem where so many LPs. Investors in funds find this important. GPs find it inherently important. They realize they need to take it seriously. So it's really now about implementing it. But the complexity that you face is that ESG is a very broad concept, and I think that's we will jump to. I think we will discuss financials as well, but just for example, if you have 3 companies, a financer of SMEs in Mexico, a pharma producing company in Nigeria, and a cold chain logistic company in Vietnam. I think we can all imagine how these 3 companies can generate positive impact. The leasing company in Mexico, financial inclusion; the pharmacy company in Nigeria, producing high quality medicines at affordable prices; cold chain logistics, avoiding food waste. All 3 of them will have in common that in the financial reporting, they will have a P&L, a balance sheet, cash flow statement, you can kind of imagine already how it looks like. But if you think about ESG, each three of them will have a very different approach. And that is, I think, the complexity in the approach. So you need to be general in your approach to achieving ESG, but get specific when you get to the company level. And it makes it complex in communicating about your ESG achievements. We are a generalist fund. We invest in education, healthcare, and some of the companies I just mentioned, those are actually investments we've made. That's one of the complexities, to make it really concrete. What is the real ESG and impact achievement that you make? And I think that also explains the low correlation that you explained in ESG ratings as well.
Thank you, Menno. So you brought up the issue of comparing investments, which I think it's very, very important and it's crucial. So maybe I would like to turn to to Rashad and ask you, one of the key challenges is indeed the ESG comparing of ESG scores. And I know that you have a tool called SDG Blue that is helping you with this process. So it would be great if you could share with the audience how the tool works and also maybe how it helps you with accountability and transparency.
Well, thanks for the question. Yes, indeed, when we started, and we're still very young, we're only 4 years old, we said we would, as I mentioned earlier, want to use the SDG framework. And then we started with what would be reach indicators that we would aspire to. And we are a structured debt provider to companies, not equity. So on the financial side, when we assess projects, we did what we call a shadow rating common approach, and using the Moody's methodology. And one of our staff members, a light bulb kind of lit up, and she came up with the idea of, well, we do shadow ratings for commercial aspects. Why can't we adopt this approach to have a shadow rating for SDG impacts? So the rating, commercial ratings, in fact, you take very different companies and you boil it down to what's the debt servicing capacity, if you will, across the board. And that was the approach. So that to adopt an approach that allows us to compare. So we came up with what we now call SDG Blue, which is an approach to assess the impacts, positive and negative, of projects, and we give them a rating from 1 to 10, and this allows us to compare. Now, it's not so easy to do this. We've selected 4 criteria that we use across different industries. So one of them is gender impact. A second one is how innovative is the entity that we support. A third is broad assessment of their impacts, sustainability impacts on climate, on the environment, and finally, what we give one of the highest scores to is impact on employment. We all know that employing people is very important, giving them good jobs. So we assess all projects along these 4 dimensions, and we give them a score for these dimensions. Then we select 2 that are specific by the business. So as an example, how many people you reach through a financial intermediary, or how many in a healthcare project, how many people you treat. So we add these 2 components to the first 4 and then give them a score. So that allows us to compare across the board and make choices. And of course, we have a minimum line that they have to meet, but it really allows us, and we don't do anything below a 6. But really allows us to select in the 7, 8 range. Very few come out to 9. The other thing this allows us to do is to track companies through the life of our investment, and so that their scoring can improve or it can be reduced. And we make this public. So the idea is to provide an incentive for companies to try to improve. So there are a lot of benefits. We don't think we've solved all the problems. We're very open to getting inputs on how to continue to improve. We're happy to adopt others. We are signatories to the UN PRI approach, so happy to learn from others, but that's something we thought we could contribute, and it is open, so anybody can adopt it. We were happy to share how we use it and continue to try to improve it.
Many thanks, Rashad. I think this is a very interesting tool that many organizations would be happy to look into. And thanks for mentioning also that you publicly disclose the scores, because that's really a great step towards transparency and also accountability. So maybe, Nicole, I would like to ask you, since Rashad also mentioned they are signatories of PRIs. So how does being a signatory of PRI help organizations with their accountability, or more in general, what does it mean to be a signatory of the principles of responsible investing?
Sure, well, thanks. That's a great question. And it's always good to have signatories as part of these discussions, showcasing that there is no sort of standard way to do this. But I think what's important to remember is that being a signatory to the PRI is to make a paid, public, and monitored commitment to implementing the principles of responsible investment. And those are really all about integrating ESG into your investment decision-making processes and your active ownership or stewardship activities. And what PRI does is we provide principle guidance on what does best practice look like for responsible investment in particular asset classes or with respect to specific ESG issues. But we understand that obviously the way that these principles are implemented needs to be appropriately nuanced. It needs to be context specific. And what that means is that there's going to be cases where there are two investors in the same market with the same information who are both implementing a responsible investment approach, but end up making different decisions about a particular asset. And that's okay. It's about understanding the spirit of the principle, which is essentially to try as much as you can to incorporate ESG into the decisions that you make, into your risk-adjusted return calculations. And for some investors, that might mean divesting from particular assets. For others, especially in emerging markets, and we take Africa as an example, where markets are small and illiquid, where divestment's not an option, it might mean more focus on engagement and stewardship and working with those companies to help them transition so that they might not meet your sort of ideal ESG criteria now, but they can in the next couple of years if you work with them. And I think it's, so to be a PRI signatory is to sort of take that expanded view of your investments and to understand them more holistically. And I think I like the point that Rashad made about their tool when they're talking about it, is that what's important is not a particular score or even which particular, issue you are prioritizing. When you think about the SDGs, there's 17, but there's 168 targets within that. I mean, if you try and hit all of them, you're never going to get there. What's most important is that you have a really sound methodology in place for identifying what is material. So in this context, with respect to this particular investment or this portfolio, or for me as an investment house, what are the material issues on which we would like to focus? Have I thought about that properly? And then am I making sure that that priority carries through in every investment decision? If I'm investing directly, am I incorporating it using either internally developed frameworks and tools or some sort of standardized framework that's available? And if I am outsourcing management of some of my assets, am I making sure that those managers are properly integrating my values and my principles into the way that they operate, and am I holding them to account? So being a PRI signatory is really about making that commitment to continuously grow and improve, because this field is so rapidly evolving. There's really nobody that's sitting back with their feet on the desk and they've got ESG all figured out. Like, if they tell you they do, they're lying. It's changing every day. So this is really a commitment to learning and evolving and just constantly making sure that you are broadening your approach and taking these things into account and adaptively managing going forward.
Thank you so much. And I think it's very nice that you're saying that we're all learning. That's very important, because sometimes this ESG and sustainable investing seems like huge and complicated as an area, but in fact, everybody is in the process of learning. So maybe I would just want to ask you one last question to all of you before we turn into the discussion with the audience, because I saw there are already quite some questions coming in. So just to, Ben already raised, or Rashad, I think one of you already raised this issue about whether financial materiality should be the only reason to opt for ESG investments, or whether there are other benefits. So I just wanted to get a better sense from you about this issue around ESG value creation. So we all know that there is a cost associated with ESG due diligence, monitoring and disclosing, which can detract from the financial return and make it more difficult for companies, or can become burdensome for companies. So maybe starting with Menno and Rashad, if you had to pitch ESG investment, why would you say that it's worth it? What are its main advantages? And should the focus only be financial materiality for the investors, or are there other benefits?
Sure. Look, the inherent ESG benefits, I think, are clear for a better society and where we all want to live in. But I'm also a strong believer that there are the benefits, the financial benefits, weigh against the financial costs as well. And I think you can achieve higher returns by investing in equity and having a focus on ESG. But what I think what is important with ESG and impact, often when you think about the financial part of it, is that the expenses that you make, it's a bit more difficult to see the immediate return of it. And what I mean, if you have a company and you invest in a plant, the entrepreneur really understands, okay, these are the number of products I'm going to make and what I'm going to sell. That's clear to them. But I think there's still more uncertainty around investing in ESG matters. And sometimes the payback period can be a bit longer, which can be difficult for entrepreneurs. We have encountered entrepreneur in Kenya who wanted to change his factory from conventional power led to solar power, and the repayment period of such an investment is 4 or 5 years, and in emerging markets that's a long time. So we looked for support this company to bring back the payment period to 2.5 years, and then suddenly it becomes more beneficial. And but I think very often the costs of implementing ESG are overestimated. If you do it well, if you focus on it well, I think the returns can be exponential. And we talked about gender balance, for example. Rashad mentioned that. That's for us also an important focus point. We have seen in many instances where when you invest in supporting the women in the workforce, making it more, let's say, easier to work there, have good maternity leave programs and all of that, you immediately increase the productivity, and that really hits immediately the profit lines. And further down the road, when you want to exit a company, investors will look at it, strategic buyers will look at it. It shows that it's a company that you show that you have a long-term view. And more employees find it important. In emerging markets, it can still be difficult to find talent for companies, and young people in emerging markets, just like in the developed world, are much more conscious, I would say, than young people in older generations about ESG matters. And I think that's also very, very hopeful for them.
Thank you. Rashad, do you want to comment on that too?
Yeah, it's a fascinating question, and there's no simple answer in my view. I completely agree with Menno that, again, the origins of this whole approach was just to reduce risk. The do no harm, safeguard approach was more of a risk management approach. And that, in principle, if you reduce your risk, you should, in theory, improve your returns. So I agree with that. I also think that, and we see it with our clients, increasingly, some are more there already. We have, for instance, one CEO of one of our companies called Movi. It's a fintech company in Colombia who's just absolutely passionate about providing access to finance to the underserved. Colombia, where he operates, is one of the least well-served countries in the world. So he's just passionate, and he loves talking to us about how communicating what he does. But others were not there when we first engaged with them. They weren't there. But there's one other CEO, an IT services company in Brazil, who is just adopted this whole approach. Says it's fantastic. I really want to bring this into my company, and throughout the company, I see that it can have a lot of positive impacts. So it's not just negative. Avoiding negative, but positive in the most obvious place. And he says it's a way to attract and retain talent, to be able to communicate the good stuff you as a company are doing. Now, whether that translates into better returns, this is where it gets more tricky. There are theoretical reasons to say, well, actually your returns can be worse off if you adopt this approach, or if you eliminate certain sectors from your basket of opportunities. I have some sympathy for that theoretical argument when you're investing in listed equities. And a lot of studies have been done on listed equities, and the evidence is rather mixed as to whether adopting an ESG lens or SDG lens, or whatever the lens is, really ends up having a positive impact on your returns. Our approach is we're not going to promise higher returns than otherwise, but we have as a goal to attract institutional investors into our funds, and institutional investors will not come in unless you can assure them that you can get a market-based, risk-adjusted return. However, what we're also saying, we will ensure you get that, but we will also ensure that you have clarity on what the impacts are, again, positive and negative, and that we have a hurdle on net positive impacts, and that we'll be able to disclose that and be able to tell you, so that you can tell your investors. So it's a no trade-off approach. We're not promising higher returns than they would have gotten otherwise.
Thank you. Thank you so much. So maybe, Nicole, if you want to share also your insights, you have already sort of mentioned some of this in your opening remarks, but please, if you want to add anything before we turn to the questions from the audience.
Sure. I think, again, it's a really good question to sort of think, is it the investor role to worry about this? And I think the answer from my side is absolutely, because the role of investors in the entire industry is to create value. In terms of the value you create for shareholders or stakeholders, ESG integration into those decisions is important. And as the market, the global market, and the international as we evolve in our thinking and we start to get a clearer sense, something like the pandemic brought it really close to home, is that what do we actually value? I mean, we were willing to shut down the entire global economy to protect human well-being. And so as an investor, if your job is to create value, you need to start thinking about what is that, and is it something beyond returns? It doesn't mean there's no return, because that enables all the other things. And so I think when it comes to that question of, why should the investors care about ESG beyond just the returns, it's because of the value that it creates and can create. And it's not investors' job to solve all the world's problems, but it definitely shouldn't be your role to make them worse if your purpose is to create value.
Thank you so much. So we have a few questions from the audience. I think we can try and answer them right away, if that's fine with you. So the first question, I think it's for everyone. Maybe I'll pose it to Nicole, and then if Menno and Rashad, you want to add anything, you're welcome. Nicole, how can we increase the awareness of the fact that ESG is different and distinct from impact and contribution to the SDGs?
Yeah, I think that's a really great question about how do we create awareness. I think there's a lot of work happening at the moment around that. We at the PRI, for example, have our sort of online academy, but we've also recently developed a free online course for African asset owners specifically, because we found that there is a bit of confusion around that, and there's a bit of pushback around in emerging markets in general, the idea of having to worry about these things when you've got much more palpable issues on your front doorstep, things like unemployment and inequality and poverty. You see that every day. So when people start talking to you about SDGs or impact or climate, you sort of feel like it's not a priority. So the first thing about how do we raise the awareness, I think it's having these kinds of conversations and sharing the information when you've got it. I also think that there's a big role to play for the sort of academic institutions that are producing, current executive education courses. So if anyone who's doing MBAs and postgraduate qualification for finance professionals, it's really important. And then institutions that are grooming sort of the next generation of finance professionals, I think there should be a base level of climate and, I suppose, SDG or impact competence to be a leader in an organization today or tomorrow. I think that's a good place to start.
Thanks. Rashad, Menno, any comments from your side on this one?
No, I have little to add to what Nicole said. I think these kinds of conversations, I think it is an important point. ESG framework, there's so much talk about ESG in the industry, but it is distinct from, I think, from what we're trying to achieve, which is an emphasis on net positive impacts. There's some overlap clearly, but there is definitely some confusion about the two approaches.
Yeah. I don't see them necessarily.
Go ahead. Sorry.
So I was going to say, I don't see them biting each other also. I think, as Rashad mentioned earlier, ESG, at least historically, has been more focused on the risk part of it, make sure you don't go below a certain line of risks. And impact and SDG is much more focused on what can we really achieve, how can we improve the theory of change. So I think they go hand in hand, just like financial investing. You need to protect your downside risks, and at the same time, also look more actively. And I think that's more recently, is okay, how can we achieve more in terms of impact on society, on the environment?
Great, thanks. So the next question is for Rashad, but of course, Menno and Nicole, if you want to add your comments, also very welcome. Rashad, can you give an example of how you assess negative impact?
Well, I'm glad somebody raised that question, because there's increasing emphasis on not just demonstrating positive impacts, but what are the potential negative impacts? What is the company doing to avoid them, eliminate them, reduce them, as well as on the investors. And the recent EU directives are putting greater emphasis on the negative impacts. I will give a specific example. It's very live for us. We're looking at an agriculture investment in a processor of agricultural products in Peru. Now, obviously, they grow some of their own, but they also buy from small-scale farmers. And in doing our review of their activities, our third-party assessor on the ESG aspects saw that there were some children in the fields, and we're trying to now dig into that. And obviously, we want to avoid child labor. So that's raised all sorts of issues. What's our minimum bar in terms of these issues? If there's any evidence, should we just avoid it? Well, the problem with avoiding things is then you eliminate the possibility to improve things. But these are very thorny questions. And so, in some cases, these children are just hanging around because they don't have a daycare center to send them to. So can we help them set up a little daycare area with some kind of supervision? That's probably the easiest aspect. Others, you have teenagers, 15, 16, 17-year-olds who are employed. Well, this happens in developed economies as well. Do you want to eliminate that, or just ban that? So these are all the kinds of questions we're asking ourselves. And I should also add, I think this is part of the learning. We're now trying to see how we can adopt our approach of SDG Blue, which I described earlier, to include these kinds of negative impacts. And I think that's one of the next steps for us to include this more explicitly. But this is a big area. I'd love to hear from my other panel members.
Yeah, look, I'm happy to jump in here. Look, I think there's too limited attention for that, and I think it's a great question. We discussed earlier also with Rashad, and the term accountability came up. If you look at with financial investments, if you do an investment and it's a complete write-off, as an investor, it will follow you for the rest of your life. It will be in the reports, in the historic reports. But there's so much freedom in reporting on impact. In impact reports, investors can easily just highlight only their successes, and also if there's a full write-off investment, you really should also question yourself, what impact did that investment really achieve? And that could well be negative as well. But there's no requirement for reporting on it. It's almost like if, as an investor, you only start reporting your profits but not your losses. And so I don't have a real. I just want to acknowledge the importance of the question, and I think there's still a long way to go there for the industry to become really accountable for also reporting on negative impacts. And I'm glad that Rashad is taking this seriously already. And I think, unfortunately, still as one of the few.
Thanks, Nicole. Any comments on that from your PRI experience?
Yeah, I suppose just to echo that, understanding the negative impacts is the only way you understand your net positive. So by ignoring it, you don't get to see in the aggregate what is the overall impact. So it's really important, and just to highlight that in acknowledging that there are negative impacts, you open the door to identify potential opportunities for significant positive impact. And so looking at it as an opportunity to generate more upside, as opposed to simply downside that you have to sort of accept and move past, is the sort of a changing attitude to apply in that context.
Thank you so much. So we have another question. This is for Menno, but again, feel free to jump in. Menno mentioned that there is complexity in that ESG is a broad topic, and I agree. From an LP perspective, which subtopics are most important, and is it industry specific?
Well, look, I think the SDGs are helpful there to channel the focus on which impacts to achieve, and we have a broad focus as a generalist investor on the different SDGs. But our core focus is financial inclusion, healthcare, education, gender equality. Those are some key topics, and we start with a generalist approach with ESG action plans for the funds that we invest in. We also invest in the different sectors, but then when they invest in companies, we look more carefully at how do they really focus on the specific ESG and impact achievements for those companies in those sectors. Yeah. So in the end, yes, you need to get sector specific if you want to really achieve a positive impact.
Great.
I'm not sure if that answers the question.
Please, Rashad, yes. I think it does, but please, Rashad.
Well, as I mentioned, we have selected, and it's a bit arbitrary, 4 criteria that we assess all projects on. So gender is one of them, innovation, employment opportunities, and impact on the environment. But then you have to drill down and those sector specific. So that's a bit the challenge that we've mentioned earlier. How do you come up with an approach that allows you to assess projects across hugely different sectors?
Maybe if I can add one more thing to it, sorry to go back. There's also one key distinction is what you can look at. Do you invest in companies that are already impactful? Or do you invest in companies that you are not there yet, but you believe are able to get there? And I guess we do both. We do, but if they're, we have a downside risk that we won't take, of course. But I think that's also an important distinction. And you really look at what change do you believe you can achieve in the companies in terms of level of impact. And at least if we believe there's a high level that can be achieved, I think it's worthwhile to invest also in companies that may not have the highest ESG standards at the beginning of the investments, but where you have a conviction you can get them there in the future.
Great. Perfect. So maybe the next question, I'll ask it to Nicole, and then again, if anybody else wants to come in. Are there certified or acclaimed external advisories that are assessing the ESG rating of an entire portfolio and do that over the entire time?
So that's a great question, and I'm sure you wouldn't struggle to find organizations that say they can do that. I think the challenge that comes in with ESG ratings is that, as we've seen with even some of the bigger global data providers, while an ESG rating at a company or portfolio level is a useful tool to have in your toolbox, it is by no means perfect. I think it's really important to understand what the methodology is that's applied, what data is used. I think, one of the problems we have at the moment, and, the coverage as well of those providers, one of the problems that we have is that a lot of the time the data that's used is publicly available data and it's retrospective. So sometimes the rating might not reflect something that's happened in the last year, for example, and that might have been really serious. What you'll also find is that depending on the methodology that's used, different rating companies that do different ratings will come up with wildly differing scores for the same company. So I suppose I do think there are companies that will help you with that. I think mainly where I have seen that kind of company-specific rating on the scale of a portfolio, it's usually been an internally developed scoring framework, similar to what Rashad's talking about, where a particular asset manager or consultancy has developed their own framework for that. But again, it's something that is useful, but I would just caution that you don't make your entire investment decision based on that one data point when it comes to ESG. But there's probably people out there that are doing that. I think the closest thing, though, something to keep in mind is something like the taxonomy that's been launched in the EU now, the Green Finance Taxonomy. And there's a couple of markets that are busy developing similar taxonomies, including some emerging markets. They've got some interesting ones coming out. That is a really good way to assess the alignment of a portfolio with a publicly stated national ESG or sustainability objective. So, for example, if in the EU context, the nationally stated or the block objective is for the EU to be net zero by 2050, and the taxonomy allows you to assess each company in your portfolio according to the criteria that have been developed for that specific industry, for that kind of project, to see whether or not investing in that company gets you to that overall objective. And those taxonomies and that kind of approach, I think, is probably far more useful than would be ESG ratings produced by sort of an independent data provider.
Thank you so much, Nicole. Then maybe this is more for Menno and Rashad. So there is a question around how you pool investment, let's say, for your funds, and how this is different from normal venture capital private equity funds. I don't know who of you wants to start answering this question.
Is this the question I'm just reading? Are your investor pool for your funds different from a normal VC fund?
Yes, exactly.
I'm not sure if I could start, Menno.
Sure, go ahead.
Reflecting on the question, if I understood it correctly, no, we are attracting the same investors that would invest in a non-impact oriented VC or PE fund. However, we also recognize that increasingly the institutional investors are just more focused. Not all, some put very little weight. They just want to know what's your expected return or risk-adjusted return, whatever metric you want to use. And they say the rest, well, it's nice to have, but it's not what I'm focusing on. Others are increasingly feeling the pressure that Nicole referred to, the market demand for accountability on the impact side of the story. It's true, there are also family offices that are increasingly more focused on these kinds of issues. Often people say it's the second or third generation that is more focused on these issues. But essentially, at the end of the day, it's the same pool of investors that we are trying to attract to our funds.
Yeah, so I can maybe just add that we invest in private equity broadly over emerging markets with a high return and high impact focus. So most of our investors want to have exposure to diversify the emerging markets private equity pool, and find it easier to get a one-stop shop to get such exposure. And I would say more than 90% of our investors find the ESG and impact approach very important as well. And that's across family offices, individuals, wealth advisors, and pension funds as well. And we do not attract that much money from DFIs. Mostly, we're actually trying to give access to private investors to emerging markets private equity as well, beyond what DFIs do.
Perfect, thanks. There is one last question that I'm going to ask all of you before we close. So ESG is becoming mainstream. I'm happy that this is now recognized. How can institutional investors distinguish a well-informed ESG investor from an ESG momentum bandwagon investor? I don't know who wants to start. Nicole?
I would love to handle that one, because absolutely you need to protect yourself from greenwashing. I think at an institutional and an individual level, you need only look on LinkedIn at how many people have all of a sudden become ESG specialists to understand how serious this issue is. But I think one of the great ways is to check with them whether they are signatories of an organization like the PRI or UNEP FI or any kind of body that sort of holds them to account in some way. Barring that, always good to ask them to explain to you how they incorporate ESG, what is their approach, what are the tools that they're using. For example, if you are in the EU or you're in a market that has a taxonomy, are they using that? Do they know what it is? Can they explain it to you? Those are really good ways to check, just to check if people actually know what they're talking about.
Menno, Rashad, from your side?
Yeah, look, I'm happy to. So I think it's first of all, I think it's great that institutional investors, I think it's started really around 10 years ago, are taking ESG and impact much more seriously. So I think that's really changed the industry. That so many more private equity firms are now also getting on it. Besides what Nicole also mentioned, I do think institutional investors should also take their own responsibility and treat ESG due diligence as seriously as you have always been treating financial due diligence already. So the more serious institutional investors take their ESG due diligence and really dive deep in what are the GPs doing and set standards there, that will really have a positive impact on the industry. And
thank you.
So just briefly, just to add to what Nicole and Menno said, and Nicole mentioned greenwashing, there's SDG washing, there's ESG washing, and it's very important for us who are trying to establish ourselves as impact-oriented investors to have the credibility and the accountability. I think these are the two key things, to hold investment managers accountable for what they are saying. So transparency of what we're doing is extremely important. That's how you keep investors accountable for what they are saying they're going to do. That they are clear. They report on what they actually have done, and to keep them. And as Menno said, on the financial side, you could investors. I mean, institutional investors definitely hold you accountable. You didn't deliver what you promised on the returns. Wow, that's terrible. Well, I think there will be increasing pressure on the impact side. You promised me you'll do X, Y, Z on impact. What actually have you done? And LPs are becoming very sophisticated and are asking very tough questions and pushing back. So this is not a trend that's going away. There will be greater and greater emphasis on basically accountability on these dimensions.
Thank you so much. I think we've come to the end of our panel. So I just wanted to thank again our panelists for the fantastic insights they've shared with us. And thank you all for participating so actively in this webinar. I just want to remind you that after the webinar close, a short survey will pop up on your screen. So we would be really thankful if you could take a couple of minutes to answer that. So thanks again for your participation. And we hope to see you at another SuperReturn webinar, I guess. Thank you.